Welcome to this Skillick Explains Finance video. This time, 5 hidden risks with exchange traded funds. Now don't get me wrong, exchange traded funds in the right hands can be fantastic, but the market has expanded rapidly in recent years and that has thrown up some hidden risks to be aware of, so make sure that before you buy one, you know what you might be getting into. So with no more ado, the good news. And there is lots of good news here. Exchange traded funds can offer exposure that is low cost, simple and efficient. So for example, you're thinking, I want access to the American market, broadly defined as the S&P 500 index. There is a product out there, the SPDR as it's known in some circles, that will give you tracking exposure to that market. It'll do it cheaply, it'll do it simply, and it's reasonably efficient. By that I mean that the ETF performs more or less as the underlying index. Great, so what's not to like? Well, here's where we need to be careful. As the sector's expanded, so the risks have increased. And there are 5 I want to highlight. There's more than 5, but here are 5 fairly large ones to be aware of. Number 1 is market risk. Now, this is basically a flash way of saying that exchange-traded funds are designed to follow an index or a basket of securities or an asset or possibly a derivative contract. Won't get into the details too much here, but bottom line is they're designed to track. So you'd hope to get the upside when the underlying thing, index, basket, sector and so on rises, but you take the hit when it falls because they are passive trackers. They have no way of bailing on their own strategy, as it were, or modifying it in a downturn. So when the market rises, so does an exchange-traded fund. But when it falls, they will track the drop. Some of them will track it precisely, some of them won't. Coming back to that in just a moment. But the point is, you have no choice. You are following whatever it is the exchange-traded fund is designed to track. Number 2, the tyranny of choice. Now, as the market's expanded, so has the number of products available. So there are around 2,000 of these things listed in the US alone, and that's a huge increase over the last 5 years or so. Some sound very similar, but performance can vary. So this is the problem you've got, is how do you shop for the right one? Supposing you want a biotech exchange-traded fund, for example, the providers can vary, the underlying thing being tracked can vary, and therefore performance can vary, and of course so can costs. So all of that needs to be taken into account. These things do have to be screened once you get beyond the sort of plain vanilla ones, just like any other investment. And some are simply bizarre. As the market has expanded, the marketing teams have gone mad. You've got exchange-traded funds that follow all kinds of esoteric bits of the market. Some of them go bust quite quickly as a result, so watch out. And not all costs are the same. Some of these things have lost sight, rather, of the idea that these are meant to be one of the cheapest ways of achieving exposure in the market. Number 3, complications. Now the whole point of an exchange-traded fund is it's supposed to be simple and efficient and low cost. But that hasn't stopped quite a few of them being far from that. So for example, to give you one example, you can get a thing which offers 2 times the inverse performance of an underlying index. Even if you understand that bit, watch out, because the performance these things generate, thanks to something called daily repricing, may not be exactly what you expect. So be careful. These are meant to be simple, some are complicated. The performance can therefore be quite hard to understand, as can actually what the underlying mechanics of the product are, and it may track an asset, an index or a derivative. So be careful. If you're buying something called an oil ETF, do you know actually what this thing is tracking? It's quite important, because otherwise you'll have no handle on its performance subsequently. Number 4, the underlying assets may not be liquid. Now, this can be a particular problem in certain parts of the market. So if you're thinking, I'd like to track high-yield bonds using an exchange-traded fund, just be aware that the underlying thing, those high-yield bonds, may be relatively illiquid itself. And that can create a problem if you get a stampede for the exit in the underlying market, the underlying bonds themselves. So what can happen there? In a worst-case scenario, an ETF could actually go out of business. The ETF provider could go out of business, but even so, without that, the ETF could suffer quite a sharp price fall, and sharper and steeper than you might be expecting because of that illiquidity risk. So just be aware of that. In certain parts of the market, it's more important than others. Finally, behavioural risk. This is ironically almost the flip side of what I just said. The very fact that a lot of ETFs can be bought quickly, simply, cheaply, and people think, well, I understand what they are, they're very simple products, means that people sometimes overtrade them. In other words, people who would normally be sensible long-term investors start getting into sort of day trading, week trading, trying to time the markets and so on. In other words, they start to destroy the very point of what they're trying to achieve, because these are meant to be cheap, but you can reduce your returns by overtrading them and incurring commissions and so on. So just be careful. The temptation to trade something too often because it's cheap is definitely there. So there you have it. There are more risks than 5, but there are 5 key ones. To find out more, editor@killick.com. And if you'd like to find out more about exchange-traded funds in general, please go to killick.com/learn and click on the Equities tab.